As a reminder, all participants' line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. I now hand the conference over to Mr. Sumit Gupta from Centrum Broking Limited. Thank you, and over to you, sir.
Thank you. Good morning and a very warm welcome to all the participants on Metropolis Q1FY25 earnings call hosted by Centrum Broking Limited. With us today, we have the senior management team represented by Ms. Ameera Shah, Chairperson and Executive Director, Mr. Surendran Chemmenkotil, CEO, and Mr. Rakesh Agarwal, CFO. I will now hand over the call to Ameera ma'am for her opening remarks. Over to you, ma'am.
Thank you and good morning, everyone. Thanks, everyone, for joining us for this Q1 FY25 earnings call today. I'm joined by Suren and Rakesh and our IR advisors from SGA. We have uploaded our updated results on the stock exchanges and the company's website, and I hope everyone has had an opportunity to go through them. I want to start by thanking each of you for your continued trust and support, and it's your belief in our vision that drives us to push our boundaries and achieve new milestones. Let me begin with giving you an overview of the industry scenario. The diagnostics industry is set for significant growth, driven by rising healthcare awareness, the prevalence of lifestyle-related and critical diseases, and the expansion of tertiary care across the country, especially in non-metro towns. Currently, we are observing increased consolidation within the industry. The standalone unorganized players are struggling to grow in terms of volume, and the health tech players are facing a stagnation in terms of wellness growth. Both groups lack the pricing power of branded players in the illness segment who offer superior quality testing and tech-enabled solutions to enhance the consumer experience. The wellness-oriented health tech players don't enjoy the same level of confidence from doctors, making it difficult for them to enter the illness space in any meaningful way. Moreover, consumer preferences for superior testing experiences are driving the industry to adopt higher standards, such as a more specialized talent pool, advanced infrastructure, and large investments in technology. These elements are now integral to stand apart in the market and scale profitably. A year ago, the industry was characterized by aggressive pricing and intense competition. However, the current landscape is shifting towards a more stable pricing environment. Consumers are now prioritizing higher quality services over low prices. There's also a clear focus on developing niche capabilities in genomics and molecular diagnostics, which is in the illness space expected to drive future growth. The industry is seeing an increase in M&A opportunities with more reasonable valuations compared to COVID times, but high quality and ethical players will always demand a premium because they are so few. New players have realized that while entry barriers are low, and scale can be built via the tail end of the market, the sustainability of the business is challenging and profitability will remain elusive by building it this way. At Metropolis, our focus remains on scientific innovation that differentiates us from the others. Secondly, geographical expansion that provides access and driving growth through strategic initiatives. I've always maintained that science is at the core of Metropolis. Our specialty segment is a key differentiator, collaborating with tertiary care specialists and providing them comprehensive super specialty diagnostics for treating complex diseases. There is an increase in demand in this segment, and it is more margin accretive due to its higher value and the specialized nature of tests which command premium pricing. To this effect, we are strengthening our centers of excellence for specialty testing by expanding our test menu and accelerating our efforts in molecular genomics. We have also created IMAB, which is the Internal Medical Advisory Board, to provide expert guidance on clinical and medical matters. Their insights and guidance will drive innovation and maintain a reputation for clinical excellence. In line with the government's focus on upskilling and workforce development, we have recently launched MILES, which is Metropolis Institute of Laboratory Education and Skilling, in collaboration with reputed universities to provide continuous education and training for doctors and technologists. We are actively expanding our market share in both core and emerging geographies, focusing on specialized tests and bundled wellness and illness packages. Currently, the top 8 Tier 1 cities in India contribute about 60% of our revenue, and we are leaders in 4 of these 8 towns, while our peers are leaders in only one such city each. Metropolis' strategy has been about deep penetration in large cities through our own and retail franchise centers, which has led to premium pricing and word-of-mouth marketing. When we look at the top 20 towns in India, they contribute 75% to our domestic revenue. We believe the growth opportunity in these 20 markets remains robust, providing us a long runway for growth and continued expansion. Given our strong operational lab infrastructure in these markets, our key strategy are to keep opening new collection centers and increase productivity at all these centers through brand trust and excellent service. This will remain our focus this year. Meanwhile, we have built 79 labs between FY21 and 24, primarily in Tier 3 and 4 markets. By 25, we will have achieved our goal of establishing 90 labs. While these markets are growing rapidly for us, they still represent a small portion of our overall business. However, the significant growth opportunity that lies ahead of us is generating revenue from these 630 Tier 3 and 4 markets where we are already present but have not focused on extensively, and therefore they contribute a small percentage of the revenue. Since we have already established the necessary infrastructure in these markets through our labs and collection centers, we believe that by intensifying our sales and product efforts, we can turn these regions into a strong growth engine for the future. Our goal over the next 18 months is to additionally expand our network from 650 towns to 1,000 towns, and at the same time focus on driving more sample loads through our existing centers in these markets. We plan to offer a full range of tests and work with both B2C and B2B channels through this franchise ARC model in these 650 going to 1,000 markets. While we extend our network and geographical reach, we also remain dedicated to enhancing the growth and profitability of our existing partners and network. Our aim this year is to create a differentiated brand and empower our services with AI and digitization for a seamless customer experience for both B2C and B2B customers. This will make it easier for customers to access services, schedule appointments, make payments, and receive results digitally. These enhancements also facilitate quick resolutions to queries and concerns, overall improving customer satisfaction. As we mentioned last quarter, exploring bolt-on and strategic acquisitions remains a key focus, allowing us to enter new markets and acquire new skills. I'm personally dedicating a considerable amount of my time in identifying and pursuing acquisitions that I believe will align with our strategy going forward. Any acquisitions will be done after due consideration of strategic benefits and return ratios over mid to long term. Additionally, we have focused our time and money on building our IT infrastructure to optimize operations, streamline processes, reduce manual interventions, and overall improve productivity. Our partnerships with renowned industry players ensure access to the latest technologies and best practices, enabling us to implement operational automation and efficiency improvements. Since we are investing significant capital in infrastructure and technology, we've established a CapEx committee to oversee these investments, ensuring efficient capital deployment. We are deeply committed to enhancing compliance and solidifying our governance framework. Prioritizing impactful ESG initiatives and social responsibilities is also central to our long-term strategy. One of the key focus areas for me this year will be to strengthen our governance to ensure that we operate with utmost integrity, transparency, accountability, and no surprises. Speaking of the quarter gone by, we have delivered strong financial and operational performance for Q1FY25 with revenue and margin growth as was expected in Q1, in line with our overall anticipation for the year. In closing, our strategy for this year focuses on expanding organically in our core markets of pathology, exploring new growth opportunities in allied services, and maintaining our commitment to scientific excellence and sustainability. With these strategic initiatives, we are confident in our ability to deliver exceptional value to our shareholders, customers, and partners. I personally want to thank our team, investors, and board for their commitment to Metropolis. Your contributions are what help us build a brighter future for Metropolis and the communities we serve. With that, I will ask Rain to now take you through our operational performance for the quarter and our strategies for FY25.
Thank you, Ameera, and good morning, everyone on the call today morning. We have had another superb quarter and begun the year on a strong footing. Our quarter one revenue grew by 13.1% year over year, well within our guided range of 13 to 15% growth for the year. We need to read this along with the fact that quarter one is historically a relatively weaker quarter for the west and south of India for the industry. EBITDA and PAT for quarter 1 25 grew by 21.2% and 31.3% respectively. This margin increase is attributed to operating leverage and operational efficiencies. We have maintained better OPEX control with costs increasing by only 10% while the revenues grew by 13%. In the coming quarters, we anticipate to build on this further better. Moving on to the operational KPIs, our patient volumes for quarter one grew by 7% year-on-year with a 6% increase in revenue per patient. Test volumes grew by 10% year-on-year with 3% increase in revenue per test. We have consistently seen high single-digit patient volume growth over the last 9 quarters and remain confident in our volume trajectory going forward as well. In this quarter, patient volume growth was partially impacted by a price increase in our B2C segment effective January 24. As I told you all earlier, typically after a price increase, there is a temporary dip in volumes for 1 or 2 quarters. However, we have observed a month-on-month uptick with volumes of June growing by 7.5% and we expect this positive trend to continue. In quarter one, our revenue from True Health, Wellness and Illness package bundling grew by 28% year-on-year. Our approach to selling packages focus on empowering consumers with health information along with providing a commercial benefit, all backed by an excellent tech-enabled service. This strategy has enabled us to upsell to existing customers, resulting in higher revenue per patient and more tests per patient. Scientifically curated packages and targeted marketing allow us to maintain a laser focus on digital channels, enhancing our margins. With continued emphasis on this approach and further automation, we believe True Health's contribution will increase with each coming quarter. Through our network expansion strategy, we have increased our presence to over 650 towns by quarter one end, up from 300 towns in financial year 23. We have successfully identified and entered markets with significant potential that face a supply-side challenge for quality diagnostic services. While we have entered these markets through a franchisee center and this expansion has boosted our revenue from Tier 3 cities, it is still early days and we believe this part of the business has a long runway for growth. Revenue from Tier 3 cities has grown by 18% year-on-year, now contributing to more than 23% of total revenues. We are committed to our expansion strategy of adding 25 labs and 500 centers this financial year with a focus on Tier 3 cities. This involves building a lab infrastructure and establishing network spokes to serve these labs as feeders, which will drive long-term revenue growth. While building labs adds to cost initially, once the feeders are established and productive, they will significantly increase our revenues in the future. Our B2C revenue growth has been very robust, increasing by 18.4% in quarter one. The B2C segment now contributes to 54% of the total revenue, up from 51% in quarter 1 24, keeping us on track to reach our target of 60% B2C revenue. Our B2C revenues from True Health and Specialty grew by 31% and 22% respectively. Our B2C revenue for the Mumbai market has increased by 18%. The overall B2C growth of 18.4 indicates we are expanding across various markets. We've also seen faster than average revenue growth in cities like Bangalore, Pune, Surat, indicating increased consumer mindshare for quality diagnostic testing. Based on our internal costing analytics, we understand that our B2C segment yields higher margins in True Health and Specialty areas, which is why we continue to focus more on these segments. Additionally, our strategic initiatives on B2B channel have enabled us to achieve robust same-store growth from our own centers in established markets. We aim to replicate the same in our partner network as well, ensuring their growth and profitability. Our recently launched partner engagement program, Metlink, will be instrumental in this regard. By providing structured support and benefits to our partners, we have enhanced our network reach and efficiency. This program will help us strengthen relationships with our existing partners and retain them, thereby ensuring growth and success. Our B2B segment has also performed exceptionally well, with revenues growing by 12.4% in quarter 1 25. Over the last 4 quarters, we have increased our market share in the B2B business while maintaining our discount structure, ensuring profitable growth. B2B revenue contribution stood at 37% for quarter 1. We have implemented several initiatives, including engagement through the partner portal, a centralized help desk, and assigning dedicated key relationship managers to enhance service levels and drive B2B growth. We have consciously decided to defocus on our institutional business coming from government tenders, low-margin corporate accounts, and aggregators. As a result, the remaining 9% of our business, excluding B2C and B2B, has grown at a slower pace than the company average, impacting overall revenue growth for short term. However, we believe that this is a well-thought-out plan, and there is sufficient potential in our B2C and B2B segments to meet and exceed our revenue growth aspirations in the near future. Lastly, regarding our broader numbers for full year 25, we hope to achieve revenue growth in the range of 13 to 15% for the year, as guided at the beginning of the year. Keeping in mind that coming quarters are historically stronger, particularly quarter 2 and quarter 4. This growth will be driven by high single-digit volume increase and favorable change in product mix, which will help enhance the revenue per patient. In terms of operating margins, while Q1 has been a strong start, we expect margins to expand further during the rest of the year due to operational leverage and seasonal factors within the business. We will continue to focus on margin-enhancing segments like True Health and Specialty through our B2C channels. As we continue building new labs at a rapid pace this year, we anticipate roughly a 1% EBITDA dilution due to the OpEx losses associated with these new labs. This dilution is already reflected in our current P&L and is expected to continue at a lesser number until full year 26, after which we should see and contribute positively to our margins for long term. I would like to take a moment to acknowledge the hard work and dedication of our partners, the trust of the clinical fraternity, and the efforts of our team. Together, we are building a stronger and more resilient organization. With this, I now hand over to Rakesh for the financial updates.
Thanks, Suren. Let me share some of the key financial performance for the quarter. Revenue for quarter 1 financial year 25 stood at rupees 313.4 crore, a growth of 13.1% YOY, with 7% patient volume growth and 6% on account of price increase and product mix change. Our test volume growth stood at 10% for Q1 financial year 25. We count profiles as one test in MHL, and underlying test count will be higher. Revenue per test has increased by 3% on YOY basis. Our B2C revenue stood at rupees 169 crore as compared to rupees 143 crore in quarter 1 financial year 24, an increase of 18.4%. Our B2C revenue for True Health grew at 31% and for Specialty at 22% on a YOY basis. Our B2B revenue grew by 12.4% for Q1 financial year 25 compared to same period last year, with B2B True Health and Specialty growing by 24% and 11% respectively. Revenue contribution of True Health segment to total revenue has moved up to 17% from 14%, indicating a growth of 28% YOY. Reported EBITDA for the quarter stood at rupees 78.2 crore as compared to 64.5 crore, a growth of 21.2%. Reported EBITDA margins for Q1 financial year 25 stood at 25%, a growth of 170 basis point year on year. PAT for the quarter stood at rupees 38.1 crore with margin of 12.2%, up from 10.5% for Q1 financial year 24, which is an increase of 170 basis point year on year basis. Moving on to the balance sheet, we have a net cash surplus of rupees 137 crore as on 30 June 2024. That's all from my side. With this, I open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Ameya from JM Financial. Please go ahead.
Thank you so much for taking my question. Congrats on the good set of numbers. The first question I have is on the other expenses which have gone down sequentially. So in opening remarks, we mentioned that we are optimizing cost, etc., which has led to margin improvement as well. So should we assume these other expenses as a structural change, or is it led by some seasonality or something? So thank you so much.
Yeah, so I will take this. So this is a combination of both. We obviously the seasonality will help us to ramp up the revenue, and that will come in bit of a margin. And then at the same time, we are also looking at some structural changes like bit of more of automations, process improvements, and efficiency coming through productivity increase. So all this combination will also help us, and at the same time, the seasonality will help us. So this is a combination of both.
So going ahead, considering we are expanding as well, so how should we look at on the margin front, if you can guide us for the full year?
So we have already guided that we will be in between 25 to 26%. So we have closed our quarter one at 25%, and we believe that we should go upside to 26% as we go further. So we will be somewhere landing at between 25 to 26% during the year for the full year.
Sure. And on the top line guidance of 13 to 15% for the full year, I believe we also said that high single digit would be coming in from the volumes, and rest of it would be maybe the mix and the price hike. So is it possible to guide us on the price hike front for next year? It would be similar nature like we saw last year. Yeah.
All right. So, see, at this point of time, there is no discussion going on the price hike because too early, for us to think about it because we just only over with 2 quarters with the earlier price hike. So, and our focus is to definitely to increase volumes, improve productivity out of the stores from the franchisees, expand into the 650 plus markets, etc. So that's what our focus going to be when it comes to the revenue growth. If any price increase at this stage or early for next year is not, under discussion at this point of time. We will take a call at the appropriate time, depending upon, what's the market conditions as well, So volume growth definitely is one of our big focus areas, and you will see that rolling out as you go towards the rest of the year.
Just want to add something to that.
Sure.
I just want to add something to that. If you remember that the 13% is a breakup of 3 things. One thing is the 7% volume growth. The second is the price input. And the third is actually the product mix, which is changing the average revenue per patient. So the price does not impact the product mix part of it. So what we will certainly see going into next year, and out of the 13%, only approximately 2.5% has been effectively added by price. So the rest of it is actually coming because of work on the ground in terms of volumes and in terms of changing the product mix. When we are thinking about next year, we obviously don't have any guidance at this point of time in terms of revenue, etc. But the way we can think about is these 3 levers. And even if tomorrow we don't land up doing price or we land up doing price, we are thinking about price as an annual or once in 18 months kind of scenario. So we don't have a timeline fixed yet at this point. But we certainly, obviously, the volume and the increase in ARPP, which is the average revenue per patient, will certainly happen regardless whether we do the price increase or not.
Just one follow-up is that if the price hike is not taken, let's say as in next year, then the ask for the ARPP is significantly higher. And are we confident of achieving that next year?
See, ARPP is factored in by multiple things, right? It's about one, educating doctors about the more advanced diagnostics that are available and therefore them recommending more specialty diagnostics for patients. That's one. The second is how much we are able to drive more of our true health, which is the bundling and the wellness, right? So as patients walk in, there are patients who want to then buy bigger packages. And what is our ability to do that conversion? Now, on both sides, as you can see, as we have shared with you in the presentation, both these areas are growing faster for us.
100%
than the overall revenue for the business. And that's what our aim is to continue to do. And we certainly, obviously, don't have any guidance at this point of time in terms of revenue, etc. But the way we can think about is these 3 levers. And even if tomorrow we don't land up doing price or we land up doing price, we are thinking about price as an annual or once in 18 months kind of scenario. So we don't have a timeline fixed yet at this point. So is to drive specialty and true health at a faster pace. And therefore, if we are able to continue to do that, automatically the ARPP will keep increasing. I think we are confident in where we stand on the execution front. And like we said, it's not that we are not planning to do a price increase. We just haven't decided on the timeline, whether it will be 12 months, 18 months. So I think we'll just have to wait for that.
Sure. Thank you so much. That was quite helpful. Thank you.
Thank you very much. Ladies and gentlemen, before we take the next question, I would like to remind the participants that you may press star and 1 to ask a question. The next question is from the line of Costa Bubna from BMSPL Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. I wanted to understand what's stopping us from growing 25% on a year-on-year basis. Why are we guiding for mid-teen growth? What is it in the market and the factors that are stopping us from growing faster? Could you explain?
So the ways our industry is structured is, you have a head and a tail. The head is really where you have your best quality doctors, best quality hospitals, and top labs, which are your customers. And then you obviously have a tail, which is made up of a lot of unorganized players, which tend to be sort of a lower standard, right? Now, the customer base that we are sort of going after is really more in the head, because in the tail, we find that, the quality of work, because there's no minimum standards in India, the quality of work and therefore the kind of discounting and the kind of service requirement, it makes your business actually not so profitable if you follow good quality minimum standards. If you try to grow much faster, you have to then be willing to play in all parts of the business, in all parts of the industry, which may then actually have a negative impact from a margin perspective, because you land up providing over-servicing unit economics of customers which are not very profitable. It might impact receivables days and fairly among other KPIs as well. So I think and we have to remember also that the market is at this point still quite fragmented and unorganized in nature. And while we've always said it's an easy market to enter from a competition perspective, it's not an easy market to scale profitably. And therefore, I think these are some of the thoughts when we are thinking about where we should really play, where we should focus our energies. Because it's easy to build scale and grow at 25%, but you're not going to necessarily get the commensurate profits that actually make this a business worth building, or a business which is sticky enough and where you're building it on the back of brand and science rather than building it on the back of pure discount. So I think our model is more unique based on science and service, and when we would like to build it in a way that is sustainable and profitable.
Right. Kaushik, we can just add one more statistic to that. In quarter one, if I look at the industry average growth of all the operators who have published the results, it stands at 12.6% and we are at 13.1%. So our endeavor is always to grow, higher than the industry average, and we are putting our efforts to be there.
Excellent. Thank you so much for that answer. Just one more question. A few years ago, we did an acquisition to expand our presence in the south. So, want to understand going ahead. Obviously, this market could consolidate going ahead. So, and we could be the ones consolidating it. So, wanted to understand where would we like to expand inorganically? Now, where are the opportunities you're seeing in which states, in which regions in India?
So, we have about 2 or 3 different strategies now when it comes to acquisitions. One is what we have traditionally done, which is the geographical expansion, right? And high-tech also, which we did in October 21, was not so much about expanding into South, as we were already the leaders in Chennai, and we were a significant player in Bangalore. And by acquiring high-tech, it accomplished 2, 3 different things for us. It helped us solidify our leadership in Chennai. And what we have found in healthcare is when you are a dominant player in a market, there are the specific benefits on word of mouth, premium pricing, profitability, all of those benefits come through. And therefore, rather than being in 20 different places, in markets, it's always better to actually be leaders in fewer markets rather than just being a very, very diversified option. So keeping this in mind, we would like to continue the strategic thought around geographical expansion. So that's one. The second thought we also have is that, there will be sort of technical or medical skills we may want to hire in terms of products, in terms of new services and new tests that can actually help us grow for the future. So there might be acquisitions also potentially linked to bringing in new service offerings into the business. And the third kind of acquisition which could be looked at could be that, we've seen a lot of entry over the last 15 years of players who've come into the market. And there are many what we call as, sort of zombie firms in the industry today, which are knowing that they're never going to make money because they're either subscale or structurally there are issues. But a larger player can potentially, turn these around with better management. So, we are looking at these three different buckets for strategic acquisition. We'll obviously, whenever we are applying our lens of acquisition, we look at not only the strategic imperative, we look at obviously the return ratios, the IRRs of these projects over a period of time, and we obviously look at the quality of the business.
Awesome. Thank you so much. Thank you. Best of luck.
Thank you very much. Ladies and gentlemen, before we take the next question, I would like to remind the participants that you may press star and 1 to ask a question. The next question will be from the line of Pranav Chawla from Antique Broking. Please go ahead.
Good morning, ma'am, and congratulations on a good set of numbers. So my first question would be regarding, we've seen a slowdown in the growth in our focus cities. So would you like to give any color on the reason for this slowdown? Is this competition, is this saturation or a high base or anything of that sort?
The focus cities, it's in this range only the last couple of quarters, 2-3 quarters, we are in the 8 to 10%, 11% range on the growth, because these are the big markets, the top markets, and already keeping with a reasonably good high, base. Our effort to drive these markets for further growth is like, just I told during the speech, is about increasing the same store growth further and also bringing in the franchises to add on to the overall growth story and also focusing on the true health and the specialty segments, right? So, this focus city in the coming days, you will see a little more upside on the growth perspective. But if you look at it, 2-3 quarters is in the similar range, and we want to do better on the focus cities.
Thank you. So that is actually very helpful. And on the M&A front, any particular geographies that we are looking for? Because some of our players are, I think, eyeing south as of now. South and east. So what would be our preferred markets, given that we already have a strong presence in southwest?
Our belief, our model is a little bit different from our peers' models. I think some of our peers look at sort of regional expansion as a goal. We always have looked at this business as a city-wise focus. And the reason for that is like the statistic that we mentioned in the speech, that out of the top 8 tier 1 markets in India, we are leaders in 4. Now, that cannot happen unless you have a city-specific mindset. If you have a regional mindset, then that will never happen, right? Because in these tier 1 markets, you have to be able to build very strong B2C. And the ability that we have is to we have built it in 4 markets where we are the leader, right? So, while we will continue looking at north and east, obviously, because those are the, we are challengers and not leaders in those markets, and therefore M&A will be helpful. But there are many cities, even in West and South, in which today we are not leaders. And therefore, if tomorrow we did get a good acquisition that allowed us to have that platform to build dominance and leadership in a market in South and West, we would not refrain from it. Because it's very different to go into a market and through a distributor and build a B2B business. But it's very different to actually go into a market and build a B2C business. And therefore, we'll be open to all markets, but obviously preference is not in it.
And then last question from my end. Given that we have changed our presentation, can you provide us the split between north, south, east, west for the quarter?
I think that's already in the presentation, right, Suren?
What is that question? Contribution? No, it's the overall contribution. So we'll look at it and provide you. We'll have noted down this.
Okay. And as well as value and volume split for our tests.
All right.
Specialized and semi-specialized. Thank you. I'll get back in the queue.
Right, we'll do that.
Thank you very much. The next question will be from the line of Sumit Gupta from Centrum Broking Limited. Please go ahead.
Hi. I want to understand about the market dynamics in the Western India part of it, and how is the pricing scenario going there, and how much is what is the competitive intensity that you see in the Western India market, particularly Mumbai region?
See, the Western India, particularly Mumbai, the competition intensity is not any lesser or more than the past, right? I mean, we continue to see similar amount of rigor from all the competitions. But of course, we have been seeing too much of, competition from the pricing point of view over the last 2, 3, 4 quarters, right? Purely on the basis of, the productivity, efficiency, product mix, etc. is what playing in this market. So we see, you have seen that we have done 18% growth in Mumbai, and now Pune is another city in the west region is doing very well. Surat is doing very well. So we are, on our trajectory with respect to growth on all the western part of the country, and as a whole also Maharashtra is doing very well for us. Any specific thing that you wanted to know, please ask. Otherwise, in terms of our action plans on the west part of it, the rigor, etc., will continue to be as it is, and it's going to help us in terms of our overall growth.
Okay. So just want to understand about the geographic mix over the let's say next 2 to 3 years. So you plan to expand into through M&A into southern market. So just want to understand, will the geographic mix remain more or less the same, or will it change over the near future?
The mix could, of course, today, west and south being our strong markets, the mix is largely skewed towards west and south at this point of time. And as we keep expanding to the north and east, and in the next 300 more towns, like we said, of course, the mix will start changing a little bit as we go forward, right? But also, to some extent, things will also depend upon where we will go and do some of the acquisitions, etc. But organically, if you ask me, the mix will definitely keep changing, and you will keep seeing north and east part of the country getting stronger. And we talked in the past that, Uttar Pradesh, Madhya Pradesh, Assam are the 3 states where we are going to put a lot of expansion plans, and also Andhra and Telangana. Right, so which of course falls in south. So you will definitely see some amount of change of the mix going forward on the market, which today we may not be as strong as what we should be.
Okay. And so just one thing on this point. So what is the rationale that you look forward to when you target a new market, just like you said, Uttar Pradesh, Assam, Madhya Pradesh? So just want to understand on that part.
What is the rationale for?
How do you target the markets? What do you see in a particular market that you focus on?
Okay, when you enter into a new market, you're asking, right?
Yes.
See, what we do, there is a science behind entering into a new market, right? See, what we look at it is, first, of course, we start with what is the population of the city, what is the medical facilities in the city, and how many hospitals, how many, physicians, and how many doctors in that city, what is the paying power of the city, what is the competition. So all this put together, we have a science, we figure out, okay, what is the right time and right market to enter, what's the right time to enter. We first, process that, and then we start with the B2B presence in that market. We go and appoint some of the B2B clients who will, take samples for us and send it to us, particular specialty samples. And when the volumes reach to a certain level, then we go there and start our own centers, and we start the B2C. And then the volume picks up to certain more level, then we'll go and put up a lab there. That's largely the broader sense of the science that we use in setting up any new cities. So we mentioned that we moved from 300 to 650 cities. Some of them we put up labs, and the rest all we have put up centers either through B2C or B2B, and we need to keep expanding these 650 cities first and grow the volumes. That's the first opportunity available. And at the same time, we'll move the number from 650 to 1,000 cities using the science that I talked about.
Understood, sir. And sir, lastly, on the present scenario in these test menu, so be it specialized or routine tests, how is the present scenario going in these? And if possible, can you provide the split between all these, like you used to provide previously? Specialized and specialized routine and wellness also.
I think we have mentioned that 37% of the total revenue is coming from the specialized testing, and the True Health, which is the wellness and the illness bundle packaging, has moved up to 17%. So 54% of the total business is actually coming from specialty and True Health, and the rest is coming from the routine and semi-special.
Okay. So how is the pricing scenario? What kind of pricing power do you have? And we just want to understand on this pricing also. So what is exactly driving the pricing down? Is it only the routine test that is there, or are you facing competition in some other category as well?
See, please go ahead, Amira.
Yeah, I'll just add something to that. See, you have to remember one thing, pricing is not a competitive on a specific test. It depends on the customer. I'll tell you what I mean by that. People think that routine tests, pricing is commoditized and specialty tests are advanced. That's not actually true. The way it works is that if you are a patient who's fine, you're not a patient at all, you're a healthy customer, then you may start looking at discounts depending on your mindset as something that drives your decision making. But even in wellness, we find there are many customers who are they're saying, look, we are doing this once a year. I don't want to compromise, and I'll do it only from a trusted player, and I'll pay whatever I need to pay. But when it comes to illness and you're sick, for example, a patient who's got heart disease, even a cholesterol, which is a very routine test, is a very important test for them. So you can't say that the cholesterol test is therefore commoditized and therefore the pricing is low. So actually what we find is that pricing is completely impacted by the criticality of the patient. And the more critical the patient, the less chances they are willing to take on something going wrong. And the more chances that they will go to a branded player that they trust. And then price actually has very little meaning because you're doing testing once a year and your average spending some 700-800 rupees. It's not, it's not a very expensive ordeal for most people. So we actually have found that the pricing is not a challenge. The only thing which is increasing every year has actually been the distributor margin. So it's not that consumer prices are coming down, but distributor margins are going up. And now that depends on your model. If you are largely led by you have built a business which is discount led and very heavily dependent on distributors, then the last few years have been challenging for you. But as an organization, as we mentioned, that has not been our model. Our model has been more direct to consumer, direct to doctor. And therefore, frankly, our discount percentages are not increasing. In fact, they've been very stable when it comes to margins for distributors. Suren, if you want to add anything.
Yeah, that's fine. I think you mentioned that.
Thank you.
Thank you. Ladies and gentlemen, before we take the next question, I would like to remind the participants that you may press star and 1 to ask a question. The next question will be from the line of Pranav Chawla from Antique Broking. Please go ahead.
Thank you so much for giving me an opportunity again. So on the gross margin front, if I see our gross margins have only marginally improved, whereas our B2C mix has continued to improve. Our focus in tier 1 cities has also improved. So on those sides, it has always been tick, but our gross margins are not meaningfully improved. So is there a particular reason why that is the case?
Yeah, so I will just add on one or two things. While you are right that this whole B2C growth and True Health growth should add the gross margin, there are certain activities which we are doing which is also taking away, like new labs which we are creating. So that actually has a higher material cost in the initial 6 to 8 month period because there are very low volumes there. And the cost of material is directly proportional to the volume. So that is one reason. Second is that we are also expanding our test menu in a lot of new geographies. So we have added a lot of new tests in new locations and in RRL. So that also, in the initial stage, we face a bit of gross margin lower in that sense. And definitely, as we are expanding our test menu every month, so we are adding a lot of new tests. And when we add new tests, especially in the facility segment, so this test comes with a lower volume in the initial stage and a higher cost. So these are three factors which actually nullify, but obviously from a long run point of view, all these are worth investing.
Sir, just a follow-up on that. So if you're saying the new expansion, I fail to understand how new lab additions is impacting gross margin, because I'm assuming these may be franchisee centers majorly, and you may be processing tests at your main center. So your other expense, the traveling, the test movement cost would be captured in other expenses, and the processing maybe happen in your main processing center.
Okay. Please understand this. We are expanding the centers to the franchises, and all labs are our own labs. The one which is coming up in tier 2, tier 3 towns is all our own labs. So when a new lab comes up, the test volumes in the initial months will be lower. But at the end of the day, we have to, once you open up a consumable kit, you need to consume in a certain amount of period, and hence, there is relatively higher material cost, from a new lab. And also all varieties of new tests that we start, right? So that is what is impacting the gross margin, like Rakesh said. And it is not anything to do with the franchisee when it comes to the new labs. Only the centers are being run by the franchisees, and labs run by us. If that clarifies your question.
Sir, in Delhi, if I'm not mistaken, the previous couple of quarters, we were taking write-offs and making provisions for the receivables that we had from the government. So is there any update on that?
So we continue to do that. Whatever revenues come from that account, we continue to provide for at this point of time. And while our efforts on collecting the monies are also on.
So, but if I'm not mistaken, we had decided that we were planning to stop supplies and until we start receiving from the government.
So there are two accounts, in the government. Obviously, one is this Aam Aadmi, which we spoke last year, and there are discussions that how should we continue the relationship. The volumes has come down particularly this year. And there are contractual obligations on Aam Aadmi which we are looking at, and accordingly we will act upon. We cannot just abruptly stop any services. These are which are publicly distributed, and there is no other contract as such as of now where we are not receiving payment, and we are continuing to supply services.
Okay, fair enough. Thank you so much. So that would be all from my end.
Thank you.
Thank you. The next question is from the line of Ashrita Jain from Nuvama Institutional Equities. Please go ahead.
Hi, good morning, everyone. Couple of questions. So firstly, on your revenue growth guidance, would it be possible that this 13 to 15% growth seems sustainable even for the next 2 to 3 years in the absence of price hikes? As things stand today, we're expanding and the focus is more on the test mix. How do you see this panning out in the next 2 to 3 years?
Okay, so Ashita, we have guided for 13 to 15% for the full year, and also, once we do that, and I think going forward also we should be talking about a similar levels of growth. And on the pricing part, like Amira also mentioned this, we are not saying that price increase is not on the cards, so we are not going to take the prices up. We said, it's appropriate time we will do that, and, we need to earlier, as of now, the industry do in 2 years, 2.5 years once, but we will keep looking at the opportunity to increase the price as we go, right? And, till then, we will focus on, the volume growth, the test mix between True Health and the specialty, and also the volumes coming from the new towns and the new labs that we launched. It's a combination of all that. So we are optimistic that the revenue guidance that we have given for this year can even be stretched to the years beyond the next 1 year.
Okay, this is helpful. My second question is on True Health. So it's already contributing to about 17% to our revenues. Where do you see it settling say in the next 2 to 4 years?
Well, I think I don't want to put a number to it because there's a great opportunity. As and when we keep exploring, we keep seeing a lot of opportunities in this segment. Bundling in the illness packages and also driving the wellness. We are clearly seeing good opportunities because one, of course, is giving a lot of good information about the health to the consumer and also commercially good for the consumer. Right, and we are delivering it through technology-enabled platforms, So and also 360-degree, it's going through all kind of touch points, whether it is digital, whether it is or service centers or from the call center. So every piece is helping us to grow this business. So as and when the consumer adoption and the awareness goes up, this only keep getting quarter on quarter. Every quarter we see that this last quarter to this quarter, last year to this year, we are seeing growth, right? So we can be sure that this will keep going. I don't want to put a number to it, for a year or two at this point of time. We would definitely like this to be a very big part of our portfolio.
Understood. No, I just wanted to understand directionally how you're looking at this.
Yeah, of course, actually, so you would see that, 17, 20, 25, so I don't want to put a timeline to that, but definitely there's a huge opportunity. As we keep exploring, we can clearly see that it's a good, portfolio that you're working upon.
Sure. And just lastly, on your expansion plans, so I see that one of your key geographies that you plan to expand is UP, and other players too are directing their expansion plans towards this region. So what gives us confidence to grow there and build successful brand given it's a non-core market for us?
Yeah, so sometime back I spoke about the science that we use for geography expansion, right? The population, the medical setup, the opportunity, the competition, etc. So we do all those kind of science and we arrive. These are the key cities when we should go and operate. And and also some of these cities are not where supply side is definitely we find deficiencies in terms of good quality diagnostics. So on the basis of that, we are identifying these towns and putting up labs, and so far our success rates have been pretty good, right? And of course, like UP, MP are all very highly populated places. Medical facilities can even still get better. So that's the reason why focusing on these cities, and we are seeing wherever we are putting up labs and centers, we are finding things getting better sooner.
Okay, this is helpful. Thank you so much.
Thanks.
Thank you very much. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Thank you everybody for joining us today for the Q1 review of results. As we've mentioned and just wanted to summarize, it's been a good quarter for us. We've been very encouraged by the very positive volume growth, the ARPP growth, and we believe that we are very much on the right track. And obviously the margin holding up as well. Usually Q2 and Q4 are the best quarters of the year for the organization, and we have already gone into Q2 with that optimism of being able to have this quarter be better than obviously Q1. We are very excited also about the other robust things that we are building in the organization, whether it's the systems, processes, technology, and really the good quality of team. And all of these things together really make us very excited about the future and really diversifying into new markets. Like we said, we are present in about 630 other markets which contribute low revenues today, and how we can really make these centers much more productive and expand further into 1,000 markets of India. So the future and the runway for growth for this industry and for Metropolis specifically is very high, and we would definitely continue to see these engines of growth keep churning, quarter by quarter. Additionally, of course, we will be looking at acquisitions as well, things that are strategically aligned to us, and look forward to accelerating the growth through that aspect as well. But we are very excited and positive, and we look forward to continue to chatting with you the next quarter. Thank you, everybody.
Thank you. On behalf of Centrum Broking Limited, that concludes the conference call. Thank you for joining us, and you may now disconnect your lines.